Hello everyone, welcome to our group presentation with the topic of income statement and related information. Before that, let me introduce myself. My name is Eka Xavier Valencia and our group Shafa, Assyifa, Evelyn, and Mezaluna. Enjoy the presentation. Okay, let's dive into the purpose of income statement. At its core, the income statement measures the success of our company operation over specific period. It is the go-to financial statement that help investor and creditor determine our profitability, overall investment value, and credit worthiness. But it's not just about looking backward. It is highly useful for predict future cash flow. We do this in three main ways. First, we evaluate past performance. By examining our revenue and expense, we can see exactly how the company performed and benchmark ourselves against competitors. Second, we use it to predict future performance. The historical trend we see in past performance give us a solid foundation to forecast our future revenue, earning, and cash flow. And the third, it helps us assess risk by analyzing the relationship between our revenue, expense, gain, and losses. We can better evaluate the risk of whether or not we will hit our future cash flow target. Even though income statement is very powerful, we should know their limitation. First, the income statement omits certain items simply because they cannot be measured reliability. For example, things like brand value or certain unrealized gain won't show up here, even though they hold real value. Second, income numbers are heavily influenced by the accounting method we choose to use. For instance, a company using strict line depreciation will show different income number than one using accelerated depreciation. Third, income measurement relies on a lot of human judgment and estimated, such as predicting the useful life of an asset or estimating future warranty costs. Because of this flexibility and relies on judgment, we have looked closely at the quality of earning. Sometimes companies have incentive to manage their income, either specific to meet their specific target or expectation, or to make their earning look less risky to investor. This leads to earning management, which is the planned timing of revenue, expense, gain, and losses to smooth out any bumps in earning. While smoothing out earning might seem appealing, the consequence is severe. It ultimately erodes the quality of the earning and compromises the overall integrity of financial reporting. It obscures the true financial reality of the business.
So we are going to talk about elements of financial statement. There is just two elements of financial statement, which is income and expense. First, income is increases in assets or decreases in liabilities that result in increases in equity. Other than that, those relating to contribution from holders of equity claim. And the second is expense. Expense are decrease in assets or increase in liability that result in decrease in equity other than those relating to contributes that other than those relating to distribution to holders of equity claims. So we're going to talk about intermediate component of the income statement. The component, there are many components of the income statement. First is sales or revenue sections. It presents sales, discount, allowance, returns, and other related information. Its purpose is to arrive at the net amount of sales revenue. Second, there is a cost of goods sold sections. It shows that the cost of goods sold to produce the sale. If we minus the sales or revenue sections with the cost of goods sold sections, we're gonna get about the gross profits. And then next sections is we're gonna talk about the third is selling expense. It reports expenses resulting from the company effort to make sales. And the fourth is administrative or general expense, reports expenses of general administrations. And the fifth is other income and expense, included most other transactions that do not fit into the revenue and expense categories provided above. Items such as gains and losses on sales of long-lived assets, impairment of assets, and restructuring charges are reported in this section. In addition, revenues such as rent revenue, dividend revenue, and interest revenue are often reported. After we get that, we're gonna minus it with the gross profit and we get the income from operations. And then the next is 6, financing cost, a separate item that identifies the financing cost of the company, hereafter referred to as interest expense. And then minus it and we get the income before tax, the total income before income tax. And then we get the income tax, a short section reporting tax levied on income before income tax. And then income from continuing operations, a company result before any gain or loss or discontinue operation. If the company does not have any gain or loss on discontinue operation, this section is not reported and this amount is reported as the net income. So the net income is the net result of the company performance over periods of time. And then we're gonna have to add the non-controlling interest, present an allocation of net income to the controlling shareholders and to the non-controlling interest. And lastly, we're gonna add the earning per share amount that are reported.
Reporting various income item. There is a gross profit. Gross profit is computed by deducting cost of goods sold from net sales. It discloses unusual revenue in other income and expense. Analysts can more easily understand an asset trends in revenue from continuing operation. The reporting of gross profit provides a useful number for evaluating performance and predicting future earnings. And the second, there is income from operation. There's expense classification, which is 1. Nature of expense method. This is just to report an expense without making an allocation, just the way it was. And then the second one is a function of expense method, which is report expense with doing the classification based on its purpose, like advertisement expenses, and then selling expense, and etc. There is also gain on losses. This should be reported directly in retained earnings or first presented in the income statement. And the third, there is income before income tax. It is deducting interest expense from income that from operation. The under of IFRS, companies must report their financial cost operation expense on the income statement. It is further differentiated between a company business activity and its financing activities. And the fourth one is net income. It represents the income after all revenue and expense for the period are considered. It is viewed as a measure of a company's success or failure for the given period. So the income tax reported before the net income, it is because this expense cannot be computed until all revenue and expense are determined. So after all of the revenue and expense, there is a net income. There is also, and the fifth is earning per share. This is the computation of earning per share is usually straightforward. Earning per share is a net income minus preference dividend, income available to ordinary shareholders, divided by the weighted average of ordinary shares. And the next one is discontinued operation. It is a component of entity that has either been disposed or is classified as held for sale. There is intra-period tax allocation, which is the process of allocation income tax expense to the specific item that generally the tax. Is the discontinued operation, there is a gain or a loss that affecting the net profit. So when is discontinued operation gain, so the discontinued one could having a gain on the net profit or net income. Meanwhile, the discontinued operation loss, it means that the discontinued make the the net income become loss. And there's also allocation to non-controlling interest. Non-controlling interest, or NCI, it represents the portion of equity or net asset in the subsidiary that is not owned by the parent company. It belongs to the minority shareholders who are not part of the controlling group. So this allocation non-controlling, it's having from minority shareholders. Even if the parents does not own 100% of the subsidiaries, it still report 100% of the subsidiary revenue and expense in the consolidated income.
Changes in accounting principle include a change in method of inventory pricing from FIFO to average cost, or the change from an existing accounting principle to a new accounting principle. Companies can change principle, but they must demonstrate that the new adopted principles is preferable to the old one. Such change result in loss consistency from period to period. A company recognizes a change in accounting principle by making a retrospective adjustment to the financial statements. Such an adjustment recasts the prior year's statements so that they are consistent with the newly adopted principle. Changes in accounting estimates are inherent in the accounting process. For example, companies estimate useful lives and residual values of depreciable asset, uncollectible receivable, inventory obsolescence, and the number of periods expected to benefit from a particular expenditure. A company accounts for a such change prospectively, which means in the period of change, if they affect only that period, or in the period of change and future periods if the change affects both. The error occur as a result of mathematical mistakes, mistakes in the application of accounting principle, or oversight or misuse of facts that existed the time financial statement were prepared. The error involves such items as improper reporting of revenue, accounting for share options, allowance for receivable, inventories, and other provisions. The companies correct errors by making proper entries in the accounts and reporting the corrections in the financial statements. Correction of errors are treated as a prior period's adjustment. They report the error in the financial statement as an adjustment beginning balance of the retained earning.
Okay, so now we're gonna talk about the financial position. There are three main components in financial position. There are assets, what the companies own, liability, the owner's claim, and equity, the company obligation. And we should remember about the accounting equation that it's assets equal liability plus equity. And financial position has two formats. The first one is account form, that is side by side, which is the asset is in the left side and the liability and equity in the right side. And the second one is report form. It's a vertical version of account form. It's like the first one is asset, the second one is liability, and the last one is equity. And the classification, financial classification, they have two. First one is current or short term, and the second one Second one is non-current or long-term. As you can see, this is the example of the financial position. The report form is vertical. There is no other. There are by top from the top to the bottom, like assets, equity, and liability. And the account form is side by side, which is asset in the left side and the equity and liabilities in the right side. And there's the account in there. So yeah, this is the example.
Thank you for watching our group presentation video, and bye bye.